No.
Yeah, I can't hear either.
Okay, yeah, I can't hear.
But we can hear each other, so it's just her end.
Yeah. You have that new microphone thing, so it could have been that.
Can you hear me now? You can't hear me now? Yes?
Mm-hmm.
Yes.
Okay. All right. Let me just bear with me. I'm just testing my mic. All right. Okay. So give me a thumbs up. There's a thing called reactions. Just give me a thumbs up so I could see your, thumbs up. There's a place where you can click on reactions, I think. Okay, good. Yeah, that's it. Good. You found the thumb. All right, good. Let me hang up my microphone thing before I break it. Okay.
You might want to go back over
So,
what you first talked
on
about.
page 245, am I low or am I loud? Do I need to speak loud, Kanan, Lauren? Okay, you can hear me. Okay, good. All right, so Sprint Nexel is the name of the company. It's a large digital wireless service provider. And in the recent year, it had approximately 32.5 million subscribers that generated revenue of 35,345 million. These are really big numbers, so they leave off the zeros. Do you notice they left off the zeros? Costs and expenses for the year were as follows. So let me see if I can, let me just share an Excel screen for a minute. Hang on. Let me do a new share. Okay. Just hang on. Okay. So here's the problem we're doing, everyone. We're doing exercise. I'm so happy to see so many of you today. It's great. This is called break-even analysis for a service company. So here's what they give us. They tell us that the cost of revenue is, they leave the zeros off. It's 20,841 million, but we'll just, keep it simple. Let me get rid of the zeros. Then they have selling, general and administration costs, G&A, they call it for short. And that's 9765. Let me just, can anybody type in the box what depreciation is? Can anybody type in the chat box what depreciation is? It's given. You don't have to figure it out. I wish there was a way that you could type on the sheet as well, but it doesn't work that way. How much? Oh, 2239. Very good, Amy. Good. Okay, let's see if I can minimize this and pull up the, maybe like move it. Let me get rid of some of these columns. Let's see if we can kind of have it side by side. Can you see the two things? Okay, let's do a new share. Let's do a new share. Okay, hang on, new share. Okay, tell me what you see. Do you see an Excel sheet next to a blue Cengate template?
No, all I see is an
What
Excel.
do you see? Lauren, I can't hear you. Unmute yourself.
I am unmuted. Can you hear me now?
I can't hear you.
Can you hear me now?
I can't hear you.
Can you hear me?
I'm gonna type. It's not you.
Oh, she's typing on the chat. What does she see?
Can you hear me by any chance?
All I see is an Excel sheet.
Professor, can you hear us?
Okay. Yeah, but there's two Excel sheets. You only see one. Okay. All right. Okay. let's do this. No problem. What's going on? What's the waves mean? I can't hear what you guys, let me try this one more time. Because I can't really hear you guys. Let me see, maybe I just didn't hook it up right. Bear with me, it's worth it. So, can you hear me now?
Yes, we can.
Oh, very good, okay. All right, very good.
Can you
Can you
hear
hear
us?
us?
Yeah, I can
Good.
hear you now.
Sweet.
That's good. I'm glad I can hear you, I want to. All right, so I'm sharing the Excel spreadsheet. Did you copy all those numbers down that I typed in, or you have your book open to that page? It's
I have-
page 245.
The book
You're in your
open.
book? You lost your book? You don't have your book today? Does everybody have their book today? Give me like a thumbs up, otherwise I have to type in the numbers. Oh, you're all good.
I
Okay.
don't have my book because it's in my car and it was pouring out. So
Oh, no, it is pouring out. Okay, did you copy the numbers I had put up?
I didn't see it. I can screenshot it real quick if you pull it
All
up.
right, let me put it up again and then screenshot it so you have the numbers. That's fine. Here they are. Here they come. Do you see them now? Cost of revenue, selling, G&A, general administrative.
Yeah, I took a picture of them.
Everybody, Amy, do you have it? Nidal, you have this?
What is it?
It's information for problem exercise 516.
Yes, I have the information on the book.
Okay, good. I'm glad. Good. All right. So now we're going to do another screen save. Let me minimize this.
Is
It's a
this
shame. I wish there was a way for me to share the whole screen. There must be. Optimize screen sharing. Share computer sound. Half the time I don't know. All right, let's see. All right, so let's see. Let me take this off. And I want to share again. Let me try. All right. Now do you see the blue, the very light blue screen? Because somehow I lost all of you now. I don't see where you are now. I don't have pictures of
It's
you.
kind of blurry.
It's kind of blurry. Okay, so that's good. So let me make it bigger. And let me see if I can lift it up a little bit. Let's see. How do I get rid of this? Let's get rid of that.
Question, is the template available anywhere for us to access?
I need to do it on screen, Cayman, because not
Okay.
everybody's as proficient as you are. Is this big enough for you, or should I make it a little bit bigger? How's that? Is that
Yeah,
better?
that's perfect. That's perfect. Yeah.
All right. So I'll narrow it down. All right. So based on the information on top of here, has anybody looked at the book and saw what goes on top of this equation? I'm going to put the drop down menu. It's one of these items. So look in your book and see if you can tell me what the answer is. Type it in the chat box. What you think the numerator of the break-even equation is. Let me see.
Total fixed cost.
Pardon me? Fixed cost? Very good, Nidal. Yes. Fixed cost is the answer. Very good. All right. So now on the denominator, we're going to have two things happening. It's going to be one a number, and then we're going to subtract the other number. So what number do you, well, we know it's not the fixed cost per account because we already used that one. So it's either revenue per account, or it's total fixed cost, or it's variable cost per account.
Variable cost.
It is variable cost, but it's going to be over here, the variable cost. So what do you think is going to be over here? Variable cost, that's the expense on one side. What do you think is going to be on the other side if we're trying to figure out break even? What's
Just
the
move my,
opposite of an expense? What's the opposite of an expense? What's the money coming into a company?
Revenue.
Revenue, very good. So here's our equation. Please write this equation down. Somehow it doesn't like this one. Let's see. Total fixed cost, excuse me. It's very fussy. It wants total fixed cost. So Please write this in your notebook. Break even, parentheses, in accounts. I'll put it in the chat box. Break even in accounts, because you'll be referring to this. The whole crux of this chapter is about this equation and knowing how to graph it. So if you know this equation, you're pretty much doing well with this chapter. And it's divided by revenue per account less or minus variable costs per account. Okay. So let's see what kind of numbers we have to put in here. Complete supporting schedule. So that this is what I like about Cengage. They tell you what you have to do. They give you like pointers. So we have to go down here, complete the schedule. So what's the total revenue in millions? What's the total revenue in millions? What do they tell us? The number that you copied, the one you took a picture of, Lauren, is it? For some reason, I don't have your pictures up anymore. I don't know what happened to them. I can't see you.
35 to 345 million.
Let's see if it has a drop-down menu. No, we have to compute. $35,345. Okay, Nidell, it likes that number. Then the total accounts in millions. How many accounts, how many subscribers do they have?
32.5.
Okay, 32.5. So now we basically just have to do a division. So this divided by this. So this is revenue per account. Does this say revenue per account, class? So we're going to put this number in here. Okay, I just took this number we computed and put it up here. Does everyone see that, or did I lose you? I wish I could see all of you. I can't even see your faces. I don't know what happened. I lost the video of you guys. Let's see. Breakout rooms. I don't know. I don't know why I can't see all of you for some reason. Okay. Here we have the cost of revenue in millions. The cost of revenue in millions. So let's see. Well, let's go back up to our equation and let's see what they want us to do here. Compute the calculation below. This is the total fixed cost. Let's go down to total fixed cost. Let's do that one first. So the cost of revenue in millions, let's see if we put in the 35,345. No, it doesn't like that. Okay. It's 20841. So the cost of revenue for that year is 20,841,000. Then what is the selling general administrative expenses? Can someone type it in the box for me? Lauren, thank you for your correct answer on the revenue. Could somebody other than Lauren, oh, Amy? Good job, Amy. Good job, Amy. All right, and depreciation? Depreciation, what about you, Duncan? What's the depreciation number? Do you see that in your book on page 245? Can somebody help Duncan? Good job. Very nice. Good job. All right. So now we have the fixed percentage. So they tell us in the problem that assume 70% of the cost of revenue and 30% of the selling and administrative. So we're going to put 70% here. They give us these numbers. Nope, doesn't like it. Okay, let's see. So that's not right. Let's try the 30%. Could it be? Yeah, it's 30%. Okay, 30%. Nope. All right.
So the cost of revenue is 30%. The selling and administrative expense, let's see how much that is. Assume 70% of the cost of revenue and 30% of the selling and administrative. All right, so let's times this one out. This times this. Okay. The selling and administrative. The problem is very unclear. It's probably, they must have flip-flopped the numbers. This is 70%. They probably misprinted it in the problem. So equal plus this times this. And finally, the depreciation is going to be 100%. So that's going to be 2239. So we're going to add up all the fixed costs. So we have this plus this plus this. And we need this number that we just got is going to go on the top of the equation, on top of the fraction. Okay? So we got this number from here. We got this number from here, the total fixed cost. Now we have to determine the variable cost. So the cost of revenue in millions should be the same as we have here, 20841, because it's the exact same verbiage. This should be the same too, 9765, because it's the same verbiage. The percentage of variable cost, they tell us is, let me read. The variable cost is 70%. So 70% of revenue is going to variable cost. So if I make a doll and I get $100 for my American Beauty doll, $70 goes to making that doll. So now we have the selling and general administrative. That's going to be 30%. So now we times it out based on this worksheet. Sometimes knowing how to fill out a form is more than half the battle in accounting. It's good to know the theory, but sometimes it's just better to just know how to fill out the form, especially in managerial. So now we're just going to add. How do I know? It says total variable cost. So we're going to add this, and we're going to add this. And then they want us to divide by the number of accounts. So we know the number of accounts, I believe, is 32.5. Let's say, good. And then we're going to take this number and divide by the number of accounts. And we get 539, the variable cost per account. So let's go back up here. The variable cost per account. So what goes in that box? What goes in that box, class? Type it in the chat box. What goes in that box? We just computed it. Yes. Yes, that's right, Christopher. Good job. Good job. So we put that in there. This is not a homework problem. This is not a PQ problem. This is just us practicing. And then next, we're going to do the PQ5. And next, I'm going to go over the RA5, okay? So that's the plan for today, just so you know. So now we have to kind of condense everything. So we're going to put equals this, because there's just one number. And we're going to take this number, and we're going to subtract this number, and we get this. So now, basically, we just continue with our calculation. And the break even is 27.9 million accounts. So for them to break even, in other words, their revenue equals their expenses, they have to have 27.9 million accounts. The good news is that Sprint Nexel, according to the problem, has about 32.5 million clients. So do you think that they're working at a profit or at a loss based on that, what we just figured out? Do you think that they're making a profit if they have more than 27.9 million? If 27.9 million accounts means that they're making no profit and no loss? What do you think?
Profit.
Well, type it in the box because I couldn't hear you. Profit. Yes. Yes, yes, yes. Yes, profit with no question mark. Be decisive. You're right. You're 100% right. Very good. Very good. So take a picture of this just so you have it. You're going to have to take it in 2 shots. So, or should I make it smaller? What do you want me to do? Leave it big and just take 2 pictures of it? Let me know when I should move up the screen. I can send this worksheet to you if you want. So here we have the last piece we're going to compute. So what are the total costs? What are the total costs? Well, the total cost break even is the fixed costs, which we figured out was 15,326.8. Wait a minute, let's see, maybe I copied the wrong number. Hang on. Let me go back here. Fixed costs equal, I might have computed it wrong. Hang on, let's go back up here. I don't know why it doesn't like it. What does it say? Enter as a formula. Oh, they want a formula. Oh, yeah. Enter as a formula of variable costs plus total fixed costs from above. All right, let's see. So,
Oh, 539 probably 539 plus 15,325, and it'll take it.
it doesn't want 539. Let's try. Maybe if we use, maybe total cost is 539. You would think that would work. 15,326. Maybe it's this. Let's see. If I can't figure it out, I'm not going to waste time. This is costs. Let's see if this works. No, it doesn't like that either. Enter a formula. Let's try equal plus this plus this. Does it also, maybe it wants also the fixed costs. Let's see. Plus 15,326.8. Let's see. Yeah, it wants everything. It wants these 2 numbers, and it wants this. So it wants all of it. It wants the fixed cost and the variable costs. Then you divide by the number of accounts, which is 32.5, what they actually have. And then we get $1,010.6 million is the break even in revenue. This is in accounts. They give it in 2 different ways. This is in accounts, which is not dollars, and this is based on revenue. Okay? So take this other picture, and we're going to continue on and do PQ5. We're going to do PQ5.
Wait, how was it that you got that first number again, the 32,845?
The way I got this number is I added in costs, all the costs, which are the fixed costs and the variable costs, which are this number 14,588.7, this one 29295, and this one 15,326.10. All the costs together I added. Did I add 3.5? No, I added 15. Let me put it in the chat box. This way you have it. So it's 15, please check me because I have a habit of doing things, making mistakes. 14,588.7 plus 2,929.5 should equal what I came up with down here. Let me just come down here, which is 32,845. Let's see. 32,845. I forgot the last amount. 0.0. Okay? 0.0. All right, class, I'm gonna do another share screen. Does anybody have any questions at all about this one? Let's do the one that you were assigned. Let's do the one that you were assigned. Now start with a fresh piece of paper, okay? It's just better. Start with a nice clean piece of paper. This is what I want you to write at the top of the paper. Okay, I'm gonna have you write something before we even start the problem. All right? I'll put it in the chat box. I'm going to put it in the chat box. Okay. So on a nice clean piece of paper, this is exercise. This is your PQ5. This is exercise 5-13. It's break even in sales. Break even sales. How much sales do we have to have in order to break even? All right, break even sales is actually a hyphen in here. And next to that, I want you to put equals. It equals fixed costs divided by unit contribution margin. Okay, so that's what we're going to work on. That's what we're going to work on. All right, so turn to page 244. Does would anybody like to read that problem or no? Would anybody like to read that problem? Break even sales beginning with currently. Nobody? Okay, that's okay. I understand. I got a big mouth, so I don't mind. I was very shy once upon a time, if you could believe it, but not now. Don't have the textbook in front of me. Okay, Lauren, I get it. All right, so underneath what you wrote, a couple of lines, go down a couple of lines, everybody. Karen, I'm so happy you're here today, by the way. Please go down a couple of lines, and I want you to write this important thing, and I'm going to type it. I want you to write unit contribution margin equals selling price minus variable cost. Okay, so that's important. You need to know that, but put that at like a couple lines down from the formula. All right, so here's the problem. But I want to show you the show me. Maybe this will help. Get a little video. So let me go into your into our class, because then it gives me a chance to make sure that the thing is working for you. And let me go into what do I want to go into? I want to go into the PQs, assignments. I always go through assignments, and everybody goes in a different way. So PQ5 is here. And then you have this little connection in case you want to see the video again. So I'm clicking on that, and here it goes.
In this video, we will learn how to apply break-even analysis for a sales mix,
We can't see
Oh,
the
wait,
video.
unit selling
I'm
price,
sorry, you're so right,
and the
you're so
unit
right.
variable
Hang on,
cost
hang
for
on.
each product of Hillary
Bear
Sports
with me, I don't even know
Incorporated
where the
have been
share is.
given. From the question, we know that the fixed costs are $640,000
Okay, just
and the
bear with me.
sales
Let me
mix
start
is
again.
40% bats
Hang on.
and
Just hang on a
60%
minute.
gloves. The sales mix can be
New
defined
share.
as the relative distribution of sales
Okay.
among the different products.
Can you see a black screen in front of
In
you?
this video, we will learn how to apply
You do?
break-even analysis for a sales mix. The unit selling price and the unit variable cost for each product of Hillary Sports Incorporated have been given. From the question, we know that the fixed costs are $640,000 and the sales mix is 40% bats and 60% gloves. The sales mix can be defined as the relative distribution of sales among the different products sold by a company. Using this data, we are required to compute the break-even sales in units of product E, which refers to an overall enterprise product, and the number of bats and gloves to be sold to achieve the break-even point. Let's first compute the break-even sales in units for the overall enterprise product E, which is the sales mix of bats and gloves. The break-even sales in units is computed by dividing the fixed costs by the unit contribution margin. To calculate the break-even sales, we need to determine the unit contribution margin of product E. Remember, the unit contribution margin is the difference between the unit sales price and the unit variable cost. The unit selling price of E is $98, computed by adding the product of the unit selling price of bats of $80 and its sales mix percentage of 40%, plus the product of the unit selling price of gloves of $110 and its sales mix percentage of 60%. Likewise, the unit variable cost of E is $69, computed by adding the product of the unit variable cost of bats of $60 and its sales mix percentage of 40%, plus the product of the unit variable cost of gloves of $75 and its sales mix percentage of 60%. By subtracting the unit variable cost from the unit selling price, we determine the unit contribution margin of product E is $29. The company has fixed costs of $640,000. By dividing the fixed costs of $640,000 by the unit contribution margin of $29, we determine the break-even sales in units to be 22,069. Now, we need to calculate how many units of cricket bats and gloves need to be sold to achieve the break-even point of 22,069 units. The sales mix is 40% bats and 60% gloves. Therefore, the number of cricket bats sold at the break-even point is 22,069 units times 40%, which is 8,828 units. Similarly, the number of cricket gloves sold at the break-even point is 22,069 units times 60%, which is 13,241 units.
Okay, that was a lot of information. So let's go back to our problem. So right now we have a problem where it's not as involved. We don't have two products, thank goodness we only have one product in this problem, so that's the saving grace. Uh-oh. Wait a minute, I stopped the share. That was an accident. Hang on, screen share, just bear with me. Let me go back. Okay, so the break-even point in this problem is not as complicated because we have only one product and we have the unit variable cost. They figured it out for us. So I gave you that equation, which is total fixed costs divided by the contribution margin, which I told you is the selling price minus the unit variable cost. See if you could compute that and put your answers in the chat box. By the way, they mentioned that there's a proposal being evaluated for the selling price. They just threw that in to throw you. Use the price that they're using right now, currently.
You said we're calculating the break-even sales?
In units. In units, yes. You're calculating the break-even in units because there is a way to calculate it in money, which we saw before, or we can convert it to from units to money. But in this problem, it's just units they want. They're not asking you to do any more than that. Yes. Very good, Amy. Very good. Can you type in the chat box the numbers you used? Can you type the numbers you used? Because that's the right answer. Yes, very good. And what was in the denominator? Very good. Okay, beautiful. Excellent work. Very good. So now let's see what happens in B. B is where they're thinking about raising the price of this product. So now what would the break even be if the product is now $1,600? What would it be now if we raise the price? Yes, Cayman, that's correct. But make sure you put the words unit next to it, because otherwise you'll get confused. It's 11,250 units. Make sure you put that next to it. Otherwise you're going to, yes, otherwise you're going to be all, you'll be like, what is this money? Is this, it's good to identify what it is. That's it. So that's your PQ. That's your PQ that you'll have to do for this week. So do you think you could do it now? I think you can do it. I think you can do it now. It's not so bad once you know the higher price of product, less amount needed to be sold. Yes, yes, yes. You're right, Cayman. You're right. Less break even. That's good. So maybe it is a good idea to raise the price. You're absolutely right. Good job. Good job out of you. All right. So now we're going to, the next thing we're going to tackle is the quiz. We're going to tackle the quiz. So I'm going to do a new share and I'm going to find the quiz. Let's hope I can find it. Okay. So do you see a quiz in front of you? Does everybody give me a hands up? I don't see any of you. You have to let me know in the chat box. Could you show how? Oh, what do you mean? Could you show how? Nidell, I got out of the screen too fast. Cayman, can you put in how you got that 11,250 units? Yeah, you're right, Nidell. Cayman, would you be so kind as to type in your numbers? It's the same denominator. It's the same numerator because the fixed costs, they don't change. The fixed costs won't change. So the numerator is going to have the, what is it, 4,500,000 is going to be in the numerator. That's going to be the same. All right, I'll type it in. I think Cayman must have took a break.
No, I got it. I'm working on it.
Oh, okay. I'm sorry. Okay, I thought maybe you took a break. It's hard to talk to a screen when I don't see your faces, to be honest with you. I wish I could get you back up on the screen. I don't know how that happened. Show video. Oh, here, show video panel. There you are. I got you all back. Oh, thank God. Okay, I see you. It's much better to see faces. All right. Thank you. Thank you.
Oh my.
Okay. So again, unit contribution margin is the selling price per unit minus the variable cost per unit. That's what the 1,600 and the 1,200 represent. Very good. Okay. Let me know when you're ready. I'm just grabbing my book. Oh my God. Okay. I tried to make it more like collegiate and I have like a library tapestry in the background, but the sun is shining through and it's what is it? It's bleaching out the tapestry I put up, so I have to figure out something. Okay. So I'm looking at my book. I want to read you something and then I'm going to ask you the question. Let's hope if I can. Okay. So here's what I'm reading and let me know if I'm going too quickly. On page 208, mixed costs are costs that have characteristics of both variable and fixed. Mixed costs are sometimes called semi-variable or semi-fixed. There's also fixed costs that remain the same no matter how the activity base changes, which we saw in the prior problem. And then there's something called variable costs they vary in proportion to changes in the activity. When the activity base is produced, the activity base is units produced, direct materials, direct labor costs are normally classified as variable costs. They're directly associated with the product. Remember, we talked about the guitars. So based on all that, what do you think is the answer to question 1? The 3 most common cost behavior classifications are. Type in the box what you think the answer would be. Yes, yes, Karen, good, all of you. Yes, the answer is, I'm going to highlight it. Very good job. Let me make sure I picked the right one. Sometimes, you know, they what do you call, they shuffle the questions, so you got to be careful. You can't just say it's answer B. Be very careful. Okay, so very good. So let's look at the, anybody have a question? Nidell?
But the test already done today at 3:20.
Oh, you finished it already?
No, it's gonna be locked after.
No, I made the time. I made the time later.
Oh, I already attended it.
Oh, you already attempted it. Did you want to try it again?
Please.
Oh, I'll give everybody a second chance, okay?
I appreciate you.
Yeah, I'm going to make everybody have a second chance. That's fine. Okay. I'm glad that you were very fastidious in getting the work done, but I'll give you all a second chance. So here's the next one. Now, here's the equation you're going to use to answer this. It's actually, you got to do 2 equations. So Straight Company manufactures office furniture. During the most productive month of the year, 3,000 desks were manufactured at a total cost of $59,000. In the month of the lowest production, the company made 1,125. Let me just take this off here. It's pretty scary. Lowest production. The company made 1,125 desks at a cost of $38,000. Using the high-low method, they call it the high-low method. You'll find this on page 209. So here's what you need to do. First, you find the difference in the total cost. So the total cost is $59,000 minus $38,000. So step 1, you find the difference in the total cost. $59,000 minus $38,000. That's step 1. Okay. Let's see. And then step 2, you want to find out the variable cost per unit. Should I type this in the box? Or can you write this down? Type it in the box? All right. You know, this book is like so cumbersome. All right, let me just get rid of this textbook. I'm going to end up killing myself with this textbook. I hate this book. It's just so cumbersome. I like the good old-fashioned books. The binder book to me is just too crazy. Okay, so difference, let me see. Let me get over here. So difference in total cost equals total cost highest level less total cost lowest level, low level. Could you all type in the box what you got as an answer? I don't know. I typed this in. Did it go through to everyone? Okay. All right. So type in when you think the answer to that first step. That's step 1. here is step 2. While I'm typing this in, you compute that. Variable. Yes, that's correct, Nidell. Variable cost per unit hang on, equals the difference in total cost divided by difference in units produced. Now, pay attention to the word difference in units produced. So you have to take the difference. All right, 21,000. Anybody else get 21,000 for the first step? Lauren, did you get 21,000? Cayman? You good? Okay. So good. So step 2, you take the total, the difference in total cost, which you computed in the first step, right? What was that? 21,000. You divide that. Yeah, thank you, Lauren. You divide that by the difference in units produced. The difference in units produced. And how do you get that? You take 3,000 minus 11725. Does everyone see that? And you end up with 1875. That's the difference in units produced. And then you take the 21,000 and divide it by 1875. This is going to be in dollars. What do you get? This is going to be in dollars, the answer. What do you get? Okay, good. $11.20. Very good. It's 20 cents. There's a zero because it's pennies. So now the last computation, so you have your answer, is total fixed costs the highest level equals total costs minus variable costs per unit, which you just computed, times units produced equals. All right, so try doing that and tell me what answer you get. So far, you're all doing great. Remember to do the thing in the parentheses first before you include it in the computation. Yes, Cayman. Very good. I put the numbers in. Very good. Yes. Good job, everybody. So your answer would be which one? A, B, C, or D? Yes, it's this number here, 25,400. Good job. So we had to do 3 steps just to get that one answer. That was a lot of work. So here comes question number 3. The systematic examination of relationships among selling prices, volume of sales, and production costs and profits is termed, what's the name of this chapter? What's the name of this chapter? What's the name of the chapter, class?
Cost, volume, profit analysis.
Yeah, that's right. So that's the right answer. Very good. Very good. Okay, and that's on page 212 for that. 212. Okay, here comes another one. Here comes another one that involves some this chapter is a lot of computation. Not all of them are, but this one is. A firm, let me come up here. A firm operated at 90% of capacity for the past year, during which fixed costs were $420,000. The fixed cost, no matter what we do, is always going to be the same. Whether we make $1 or whether we make $100, we're still going to have the same fixed cost. That's just the nature of fixed costs, which means the rent and everything that we have to pay the same every month. The variable costs were 40% of sales, and sales were $1 million. Operating profit was. So this one has a couple of steps too. So the first step is to take variable costs equal sales times 40%. So what do you get there? What do you get there? Yes, 400,000 is the variable costs. Now we have to figure out the contribution margin. That's the next step. So we take sales less variable costs, or 1 million minus 400,000. What do we get? I got lazy. I didn't put the commas in. So the contribution margin in this case is 600,000. Okay, so that's step 2. Last but not least, we figure out the operating profit. I'm going to let you do this one, but I'm going to give you the formula. Operating profit equals the contribution margin, which you figured out, less the fixed costs, which are always the same no matter what. So tell me what answer you get. Very good.
What's the
180,000. Very good. Anybody not sure about that number? Anybody confused about that number? I see everybody typing it in. Good job.
what's the end, please?
180,000, which is the contribution margin less the fixed costs. And we figured out the contribution margin was 600,000. We subtract the fixed costs of 420,000, and we end up with 180,000. That's the operating profit. Good job. Very good. All right, I'm going to move on to the next one unless somebody wants me to stop not. Okay, so the next one is Johnson Plumbing. No, sorry. If fixed costs are 250,000, the unit selling price is 125,000, and the unit variable cost is $73. So selling price, we got something we're selling for $125. It has a variable cost of $73. What is the break-even sales in units? What is the break-even sales in units? So the break-even sales in units, I'm going to put the equation. It equals fixed costs. Remember we did this problem before, the first one when we first saw each other today, divided by unit contribution margin. And remember I told you the contribution margin is selling price minus variable cost of a unit. So see if you can determine the answer to this one. The answer will be in units. The answer will be in units. You're close, but you have to be more precise, not just 5,000, Christopher, but that was a good, you're in the right ballpark, but go back to the drawing board and put in the numbers and use a calculator. You're close, but no cigar. You're very close. Because you know why? I don't even have a choice of 5,000 here. So based on your answer, what choice would it be? But you have to be more precise. Yes. Yes. Very good. Yep. 4,808 units. Very good. Okay. Let's go to the next one. All right. I'm trying to remember the roller, Cayman. Sometimes I forget. All right. So Johnson Plumbing. I don't know if it'll. Okay. Johnson Plumbing fixed cost of 700,000. And the unit contribution margin, please move this window away from the shed. I don't know what's going on here. I tell you. Can you still see the multiple choice thing or no? Okay. Johnson Plumbing has 700,000 in fixed costs and a contribution margin of $17. Contribution margin for the unit is the selling price of the unit minus the variable cost. That's how they got the 17. What amount of units must be sold in order to realize an operating income of 100,000? They call this a target income. So in this case, they don't want to just break even. They want to make 100,000. So they have a target, T-A-R-G-E-T, income. So how do we do that? How do we do that? So the formula is sales in terms of units equals parentheses fixed costs plus target profit, end of parentheses, divided by the unit contribution margin. This is on page 219, but I will type it in the box. Okay, that's the formula. See if you can come up with the answer. And the answer will be in units. Yes. 47,059 units is the answer.
It's rounded up.
No, round it up.
Yeah, it's 47058.8.
Oh, yes, yes. Round it up to the nearest dollar. Very good. Because we don't have 47058.6, so we have to take the round it up. That's the choice. Very good, Nidell. So with this amount of units, we're going to have a profit of 100,000. Okay. So here comes the next question. The point where the sales line and the total cost line intersect on the cost volume profit chart represents, who wants to take an educated guess? What have we been talking about this whole time? Can someone give me what they think? Okay, yes, yes, yes. Lauren, excellent. Exactly. So if you were to look at a break-even graph, you would see the two lines. Where the two lines intersect at that point, that's the break-even point. You'll see pictures of that in your book. Very good. Here comes, I don't know what number this is. I think it's 8. In a cost volume profit chart, the total cost line begins at the total fixed cost value on the vertical axis. You could look on page, 245. There's a picture of one there. The slope of the total cost line is dependent on the fixed cost per unit. The total cost line normally ends at the highest sales value. The total cost line begins at 0. Let me see if I can find the answer. Oh my God. Type in the chat. Oh, total fixed cost begins on the vertical. Total cost line begins at the total fixed. Hang on. Total fixed cost on the vertical axis. Cayman, you're correct. Where did you see that answer? Where did you find that answer? Could you tell us? Cayman?
Well, I'll have to go back in my book because I did this RA last
Ready?
week.
Do you also? I'm going to give everybody a second try. Did you get a perfect score, Cayman? Oh no! Don't say it. I'm sorry. Don't say it. If somebody gets a perfect score, and I check and see that you got a perfect score, I'm going to throw in an extra 2 points to you because you got the perfect score before the class. So you deserve some extra points. Let's see. What was it again? The total cost line begins at the total fixed value. Now it begins at let me see, at the total fixed cost value on the vertical axis. I just wish I could see that written. Your answer is correct. Your answer is correct. I just would love to find it, but this is the answer. The cost volume profit chart, the total cost line begins at the total fixed cost value on the vertical axis. Okay, I just want to make sure that that's correct. I just want to be double sure. Yes. 9. The relative distribution of sales among the various products sold by a business is. Now, when you were watching the video, the lady mentioned this term. Do you remember what she said?
Sales mix.
A, business basket of goods. B, contribution margin mix. C, sales mix. D, product portfolio. Yes, Karen, very good. The answer is sales mix. Very good. Yep, that's what she said. That was with the bats and the baseball bats. What was it? Mitts, gloves, and bats, I think. Last question, and I can let you good people go, unless you have questions. Ford Company has an operating leverage of 4. Sales are expected to increase by 12% next year. Operating income is, operating leverage, excuse me, of 4. So here's the calculation. The percent change in income from operations. The percent change in income from operations equals percent change in sales times operating leverage. Percent change in sales times operating leverage. And the answer is in a percent. I'm going to type it in the box. Percent change. Okay, let's see. Percent change in income from operations equals percent change in sales times operating leverage. And they gave us those 2 numbers. This one wasn't too bad. You just only have 2 numbers. You just had to notice to multiply them and not divide them. So what answer did anybody get?
48.
Yeah, 48, Nidell. Very good. It's expected to increase by 48%. Okay, that's it for today, class. That's it for today.
I just send you a message, please, and send you an email if you read them, please, for me.
Oh, sure. When you have time, could you please? Okay. Yes, I'm going to do, thank you for, yes, I can't do it while I'm giving the class, but I'm going to do that right now. PQ, okay. Oh, this was PQ5. I'm going to do the 2 attempts for PQ5, and I'm going to do that other thing you asked me. Professor, I need access code. I don't have an access code. Oh, an access code for the last Zoom. You know something? I don't think it recorded. Can you talk to your colleagues that are here right now, because maybe they can give you some pointers, because I know that they were at the last meeting. Somehow it didn't record, Karen. I don't know what happened. I don't know what happened. I'll take another look, but I recorded it to the cloud. I don't know what happened. Maybe I pressed the button by accident, and I don't know. I'm sorry. All right, I'm going to say goodbye. I've got some things to do with the PQs, and have a wonderful evening and have a wonderful supper.
Thanks.
Bye.
Bye, everybody.